Alphabet is out with its numbers now. The cloud number, which we had talked about being so important here, does look like it's a little bit light of estimates, although numbers overall beat estimates. Let's run through them. First quarter earnings per share, $2.81. That is 80 cents above analyst estimates. Revenue coming in at about $90.2 billion. That's above the $89.1 billion that was estimated by analysts. And that cloud revenue number at $12.26 billion, a little bit shy of the $12.32 billion that analysts had been estimating. But overall, revenue ex traffic acquisition costs, which is the measure that we look at for Alphabet's revenue most closely, $76.49 billion. That is ahead of the about $75.4 billion that analysts had been anticipating. I also want to mention ad revenue here because there's been all of this concern about, are we going to start to see, Google, like many of these companies we talk about in big tech, are not necessarily directly affected by tariffs. But if there is a decrease in ad demand or demand from businesses in some way, would they see it in advertising? They're not seeing it yet. Ad revenue at $66.89 billion. That is also ahead of estimates here. So that's something to keep in mind. YouTube ad revenue pretty much in line with estimates here as well. And the company is announcing some cash return to shareholders, a 5% increase in its dividend, and an increased buyback authorization of $70 billion worth. So pretty sizable addition to that here. The company's first quarter capex, should mention, $17.2 billion, which was also pretty much in line with estimates. I'm still waiting for the release itself to kind of update here to get some color. But just to get some instant reaction for you guys, Mark, I know you had some pretty big hopes for what we might hear from some of big cap tech. In the case of Alphabet, they seem to have delivered.
Look, Alphabet has had 8 straight quarters of revenue beats and make this number 9. So It's pretty impressive that they continue to operate at a very high level. 281 versus 201. We haven't had time to dig into the numbers all that much yet, but that's a pretty impressive beat on the, looking at not only revenues and earnings at a time when arguably the market made a short-term minor breakout today. So being that Google is 5% within QQQ, given the A shares and the C shares, that's pretty encouraging, I think, for potentially what futures could do as a result of this.
Yeah, it's interesting to see sort of the 5% pop off these numbers, because I think one of the big questions with Alphabet, just reading through different analyst commentary on the street ahead of the release, was there was definitely a growing fear that maybe the numbers come in line or potentially even miss. It seemed like some of those whisper numbers were actually lower than sort of what consensus estimates were. And so I think when you sort of make sense of how the numbers came in versus that, it's a good read. Also, Julie, you had highlighted that CapEx number. And to see the CapEx number slightly above expectations versus being below, right? Of course, CapEx being a big part of what we're talking about with these companies. I don't think we got CapEx guidance yet. No. I think that comes on the call. Yeah. And that's sort of kind of the looming big question here, I think, right?
We'll
is if CapEx comes down later this year from what they were prior to.
And one of the other big questions around Alphabet, around all of these big cap tech companies, is how are their customers using AI? Are they paying for it? What are they doing with it? We got a little bit of commentary around that from CEO Sundar Pichai here in this statement. He talked about search seeing continued strong growth. It was boosted, he says, by engagement we're seeing with features like AI overviews. He says that has 1.5 billion users per month. It's funny, AI overview. I don't know that I ever opted into it. It comes up every time I Google. So I guess that's why it has so many users per month. But he also says YouTube and Google One have surpassed 270 million paid subscriptions. So that's something to highlight as well. So interesting here. Again, on the call, we'll get more color around CapEx and around AI and what's going on there. Intel is what we're talking about here. The company is confirming that it is making some changes to personnel, and its numbers are missing estimates pretty much across the board here, particularly when you're looking forward. Adjusted earnings per share in the first quarter did beat estimates. It looks like adjusted earnings per share at 13 cents. Analysts were looking for nearly break even on that basis. Adjusted gross margin in the first quarter, 39.2%. The estimate was for 36.1%. But the second quarter forecast is for revenue of at most $12.4 billion. Analysts had been predicting $12.9 billion. And here, too, I'm looking at this statement. Lip-Bu Tan, the CEO, who's just been in place for what about 6 weeks or something? And he talked about the first quarter being a step in the right direction. But he says, quote, I am taking swift actions to drive better execution and operational efficiency while empowering our engineers to create great products. And then they talk about in the statement here, streamlining the organization, eliminating management layers, and enabling faster decision making. So the company's cutting its non-GAAP operating expense target to about $17 billion this year. It had been $17.5 billion that they were targeting, and they're targeting an operating expense target again on a non-GAAP basis of $16 billion for 2026. So really focusing on this efficiency, trying to right the ship here. But it is interesting, investors in Intel have already been so very patient, right? They waited through the Pat Gelsinger era for them to turn things around. Now they've got a new CEO. How much time are they going to give him to now turn things around? Judging from the reaction here, maybe not a lot.
Well, as I like to talk to investors about, look, it takes a long time to take a stock that's at 52-week lows and think that it can immediately start to climb back. You have a well-respected leader like Lip-Po Tan from Cadence, and so he's executing his own version of Doge now, not only with employees, but also expenses. So I think there's reasons to be encouraged in terms of cost-cutting steps and things he's doing to try to turn things around, but it's going to take time. I mean, Intel is a classic underperformer and a real laggard within the space, and for those that are looking for immediate results, you don't get rich trying to buy dips. You buy things that are at or near highs, and stocks like NVIDIA, which have led, all of the semiconductors outside of, TSM and Broadcom over the last 12 months. So, those are areas that make a lot of sense for me. Intel, it's going to take time. There's nothing, my thinking is it's difficult to put a lot of money into a stock at historic lows, and you just have to be very, very patient, unfortunately. That means you have to wait till the stock almost gets above 24, and you have to wait until you see real proof, and then you can start to put more money to work.
And Julie, it feels like a couple times over the last couple quarters, I feel like we've been talking about this name after earnings. We talk to an analyst, and they say, not quite yet on Intel, right? I'm talking about chip-specific analysts, right? They're always sort of saying, well, that's probably a story that might materialize a year or two down the road, right? And so I think we're just quarter after quarter continuing to see that and essentially confirming that whenever the turnaround story is fully happening, yes, they're starting the process now, but we're just really not quite there, right? And it feels like it's something very off in the distance and in the future that isn't quite tangible yet. Obviously, they're trying to restructure. You can see the efforts going on, but until you get a little bit more tangible evidence, to Mark's point, it feels a little bit hard to get excited about the story overall.
I want to start with Alphabet here because this is the one that we are seeing move higher after the company came out with estimates, with earnings that beat estimates by a pretty wide margin, revenue beating estimates as well. Gil, I want to start with you here because we did see these numbers very strong. The cloud revenue number may be a little bit light, but it doesn't seem like investors are perturbed by that. What did you make of it?
Well, there's two things to like. One is the search business is still growing. That's what we're always bracing for here with Google. We know that everybody is now ChatGPTing instead of Googling. So there's this expectation that we're going to fall off a cliff. That may not happen until ChatGPT and OpenAI start selling ads. So for now, the digital advertising dollars are continuing to go to Google. Backward looking, that looks great. The other thing to really like is how much Google has cut costs. They beat on the bottom line by the most. And that's the relief that you're sensing here today, even though the cloud, let's call it, was in line, which again is a deceleration from last quarter, which was a deceleration from the quarter after that. So what we like is search still growing, very profitable, even though cloud was just in line.
And Gil, what do you think about the regulatory overhang that most of these companies still have to go through and the antitrust concerns? Is that something investors should still be concerned about?
Absolutely. The Department of Justice is hell-bent on Google not having a monopoly going forward. So breaking up the 3 monopolies that it says Google already has in order to prevent Google from having a monopoly going forward with chat. So instead of Google dragging its feet, which is what it's been doing so far, we think Google would be better off being proactive, spinning off these businesses. It would probably release value to shareholders. But it doesn't look like that's what they're doing. It looks like they're going to fight back, drag this out, which is going to continue to be a drag on the business.
Angelo, I want to bring you into this and circle back around to search and ChatGPT's role in search here, or those AI summaries, because as I mentioned earlier, the company bringing up how many people are using those AI overviews, 1.5 billion users. But as I said, it just comes up when you Google. It's not like you opt into the thing. So I wonder how much added value that is bringing and how much that is really sustaining growth in search.
Yeah, no, so I think that's a great question. And, I think it's definitely going to get asked on the call, and analysts are going to want more clarity in terms of the AI monetization across Alphabet's overall business, right? Whether it be AI overviews, which is, a clear emphasis of this company here over the last couple of quarters, especially on the search side of things, or whether it be, Gemini across its ecosystem and how they can monetize Gemini. But, our view as far as search is concerned is, and the numbers were, really good in our view. You're talking about growth of 10% on a top line basis for search as well as on YouTube. So it looks like at least in Q1, the advertising side of things looked fairly healthy. We'll see if that can hold up through the rest of the year. My guess is you're going to start seeing some deceleration across the advertising landscape as we progress through the year. So we'll kind of see how that plays out. But ultimately, we do think they're going to find ways to monetize this stuff. We want to see, where AI overviews plays in terms of the role here. But at the end of the day, I think, search here looks pretty good.
So let me ask you, Angelo. So a lot of these companies have reaffirmed their CapEx. We heard from Alphabet. I guess we'll know more at the call, but both Amazon and Alphabet seem to be very positive and really ignoring a lot of the effects of potential tariffs. Is that your view, that these companies are sort of just keeping their eye on the ball, and can they afford not to be more pessimistic about what's happening, or do you think they're still doing the right thing?
I think the opportunity right now is too great for you to kind of take, the foot off the gas on the AI side of things. So I think Alphabet earlier this month did reiterate their $75 billion CapEx plan. I think you're going to hear them reiterate it again here on the call. I don't expect any change whatsoever in terms of some of these hyperscalers for 2025. I think where the issue is at hand is clearly as we go into 2026 and beyond. I think that's really the risk for many analysts in the street out there. And literally, I think, what's going to be important here is the digital ad side of things, right? If that slows or rolls over here over the next couple of quarters because of macro uncertainties, the street is going to get very concerned about the sustainability of CapEx going into 2026. And that's where you get the fear of potential cuts. And that's where it potentially kind of rolls over into areas like semiconductors and provides downside on that side of things as well.
And Gil, I'm curious how concerned you are about that aspect, right? If you tune into Yahoo Finance or really anywhere over the past several weeks, it's tariffs, tariffs, tariffs all the time. And we see that in a lot of the survey data. We see it in polling. We see it as a concern. And so is it inevitable that a company like Alphabet is going to feel a hit from ad revenue at some point?
It is inevitable. The consumer was slowing down, let's not forget, before any of this stuff happened. Then we piled on Doge, which means a lot of federal employees are going to lose their job. Then we reduced immigration, which was a driver of consumption as well. And then we put in tariffs, which is going to create some ripples in the economy, even if we don't follow through with new tariffs from this point on. So none of that is reflected in the backward-looking results. We're already hearing technology companies say, so far things are good, but we know and we feel that things are slowing down. You're especially hearing it from IT services companies that are saying their projects are being blocked, their projects are being held. And advertising is relatively early cycle. So once all these brands and companies realize that the consumer is slowing down, the first thing they do is pull back on advertising spend. That's why the March numbers are almost irrelevant for advertising. It's what are they going to say going forward? And they may not even know. We're just 3 weeks into this tariff conversation. They're likely to be more cautious on that, and they're likely to be even more cautious next time. And to Angelo's point, I'm not signing CapEx data center deals into 2026 with this level of uncertainty. None of these companies are. They're going to follow up on the commitments they've already made for this year, They already have the construction in place. They put in the orders. But to take on new investments with this level of uncertainty, highly unlikely.
So let me ask you a question. I mean, the stock was already down about 20% from all-time highs. So at what level would you say that the uncertainty is already very much priced into the stock? You know, it seems pretty compelling. They continue to beat numbers every quarter now, 9 straight quarters. I mean, it seems like the stock technically has started to really make a move for the upside. Is it right to continue to concentrate on those concerns, or do you just think the company has it figured out?
As long as Google stays as one company, it will continue to trade on its most at-risk business, which is search. Again, we are constantly in fear that those results will fall off a cliff as chat migrates traffic elsewhere, which will bring advertising revenue elsewhere. The best thing Google can do is lean into what the Department of Justice asked him to do and spin off these businesses. Waymo will trade like Tesla. YouTube will trade like Netflix. Google Cloud will trade like a high-growth software company at 10 times revenue. Right now, they're holding all this value hostage to a business that is very much at existential risk.
Really interesting there, Gail. I want to turn to Intel because there obviously is also a really fascinating story here. And Angelo, we'll get you to dig into Intel here for us. The company is confirming that it is cutting some jobs, removing management layers in the words of CEO Lip Bhutan. But what I keep coming back to is this is a company that still is just not delivering what investors want. When will it be able to do that?
I mean, I think the quick answer is that not in the next 2 years, and maybe never, right? So you kind of look at the company here, they've really kind of missed out on the AI boat. I mean, the world has completely changed over the last 3 years. They didn't have the right products out there. The emphasis was on manufacturing. It was on building, that foundry initiative out there, and not necessarily, the end of the world or something that's not going to come to fruition. But when you kind of look at them kind of missing the boat on the AI side of things, it's going to be almost impossible for them to catch up here, given the competitive pressures out there, specifically in NVIDIA. So when you kind of look here, what they're essentially kind of caught now doing is continuing to lose market share in the core data center side of things, and probably also on the PC side of things, as you've got new emerging competitors on that side of things. And ultimately, what they're going to have to continue to do is continue to right-size the cost side of things, right? So you saw a 15% cost reduction last year. You're going to see more cost reductions this year, and they really do need to, at this point in time, if you're Lip Bhutan, you need to focus on kind of getting to positive free cash flow, and that's going to mean doing a lot of hard work on the cost side of things. And right now, Street's looking at that happening in 2027, but you need to see that happen quicker.
Yeah, it seems like there's only so much they can do, right? They're cutting 20% of the workforce, and they're going to do all they can to cut costs. But if they've missed the AI boat, I mean, what steps can they do to participate and regain leadership again? I mean, it seems like the stock has been range-bound for almost 8 months now, right near $20. What can they specifically do to change that, in your view?
I mean, I think the hope is eventually you kind of build up some business on the foundry side of things, right? You're moving to 18A here in the second half of the year into 2026. Trump is almost kind of giving you somewhat of a gift here by essentially throwing tariffs on semiconductors at some point later this year. So the hope is they get some sort of momentum and upside on the foundry side of things, and ultimately the hope is maybe you could spin off that foundry business, and then you can unlock the potential the margin side of things on the product side of things. But again, you need to have some of those right products here be developed over the next 18 to 24 months.
Well, Alphabet and Intel reporting first quarter earnings just a bit ago. Joining us with some takeaways, Yahoo Finance tech editor Dan Howley. Hey, Dan, where do you want to start?
Let's start with the bad news first, and then we'll go with the good news, right? The bad news is Intel. Obviously, they beat on the top and bottom line. Good for them. Now the bad news. We'll give it a compliment sandwich here, right? One of the bad news is the weak second quarter guidance. They estimate between 11.2 and 12.4 billion for the second quarter. Wall Street was looking for 12.8 billion, so big swing and a miss there. The CFO, David Zino, basically saying the current macro environment is creating elevated uncertainty across the industry, which is reflected in our outlook. Now, there is some interesting news here. We'll go with that compliment sandwich. Now, here's the good stuff. Foundry did better than expected. The Foundry for Q1 brought in, 4.6 billion. Analysts were expecting 4.3 billion. Data center revenue also came in better, 4.1 billion versus 2.9 billion. And they beat on the client computing side, which is sales of laptops, desktops. Here's the bad news now. That beat, that 7.6 billion for client computing versus the expectation of 6.9 billion. The thing there could be that people started buying up new computers just before the tariff deadline. And so that means the second half of the year, it might be, not exactly bupkis, but, not great.
Right.
And so, that's the outlook for Q2. That kind of helps to drive that. And then what's that going to mean for 3 and 4?
Yeah.
Obviously, this is a company that's trying to reinvent itself. Lip Bhutan, the new CEO, has said, look, made mistakes. We're going to try to fix things. They're cutting on CapEx. They're going to lower headcount. And they said they're going to kind of squash some of the management levels to kind of even things out, they say. And then, obviously, Alphabet. Good news, basically.
Yeah, and they also had a big buyback, which maybe we didn't talk enough about earlier, but they did have that, as well as beating numbers.
$70 billion stock buyback authorization. They've raised their dividend by 5%, beat on the top and bottom line. I think one of the things, let's go with that compliment sandwich idea again. One of the negatives here is that cloud actually missed by a hair, 12.2 billion versus expectations of 12.3 billion, but advertising came in at 66.8, higher than 66.4, and we had also seen obviously EPS beat, it's basically a company that everybody's wondering what's going to happen with data center sales going forward. Are companies going to start to pull back now? Q1, obviously, no one was really thinking about that. I mean, I'm sure it was on people's minds, but it's not as reflective as what we saw with Intel, with that big kind of, everybody going out and buying up all the laptops, kind of like toilet paper during the pandemic.
Yeah.
But this is, this could be reflective later on as we start to see, people started cutting as tariffs came out. Now we'll see it in, Q2, Q3, Q4. It's still up in the air. Who knows what's going to happen with tariffs? I feel like every few seconds it's, on, off, on, off, on, off. It's Ross and Rachel, right? Right now they're on a break, I guess. So we'll have to see what happens in the next few quarters, though. But for Google, good stuff all around.
The tariffs are Ross and Rachel.
Yeah, that was off the dome, right?
Thank
that was
you for
pretty
that,
good.
Dan Hellie. That was pretty good. Thank you so much.